Welcome back, investors. Today, we're diving into the fascinating world of mutual funds. Whether you're a seasoned investor or just starting out, understanding mutual funds is crucial to building a diversified portfolio and achieving your financial goals. So, let's delve deeper into this topic together. To put it simply, a mutual fund is a pool of money collected from multiple investors like you and me. This pool of funds is then managed by professional fund managers who use their expertise to invest in a variety of financial assets. By pooling resources, individual investors gain access to a diverse range of investments that may be challenging to achieve on their own. The key benefit of mutual funds is that they allow individual investors to access a diversified portfolio, even with smaller investment amounts. Diversification is a powerful risk management tool that spreads out the risk across different asset classes and securities. This means that even if one investment underperforms, the impact on the overall portfolio is minimized. Now, let's explore the different types of mutual funds and how they cater to various investment objectives. Number 1. Equity funds. These funds primarily invest in stocks or shares of companies. They can focus on specific sectors, like technology or healthcare, or follow a broader market index, such as the S&P 500. Equity funds are suitable for investors seeking long-term growth and are willing to tolerate market volatility. Number 2. Bond funds. These funds invest in fixed-income securities, such as government or corporate bonds. Bond funds generally aim to generate regular income for investors while managing interest rate and credit risks. They are typically less volatile than equity funds and attract investors looking for income generation and capital preservation. Number 3. Money market funds. These funds invest in short-term, low-risk securities like treasury bills and certificates of deposit. They are designed to provide stability and preserve capital, making them a popular choice for conservative investors. Money market funds offer liquidity and a relatively stable rate of return, making them suitable for short-term goals or as a temporary parking place for cash. Number 4. Balanced funds. As the name suggests, balanced funds strike a balance between stocks and bonds. They aim to provide both growth and income by investing in a combination of equity and fixed-income securities. Balanced funds offer moderate risk exposure and are suitable for investors seeking a balanced approach between growth and stability. Number 5. Index funds. These funds aim to replicate the performance of a specific market index, such as the S&P 500 or the Nasdaq. By mirroring the index funds offer broad market exposure at a relatively lower cost compared to actively managed funds. Index funds are popular among investors who prefer a passive investment strategy and want to participate in overall market movements. Now that we've covered the different types of mutual funds, let's touch upon some additional key concepts that will help you navigate the mutual fund landscape. Net asset value, also known as NAV. It's the per share value of a mutual fund and is calculated by dividing the total value of the fund's assets minus liabilities by the number of outstanding shares. NAV helps investors understand the fund's performance and is typically reported daily. It's important to note that the NAV fluctuates based on the value of the underlying investments. Expense ratio. This is the annual fee charged by mutual funds to cover operating expenses. It includes the fund manager's fee, administrative costs, and other expenses. When selecting a mutual fund, it's important to consider the expense ratio and aim for lower cost options. A lower expense ratio means more of your investment returns stay in your pocket. Loads. Some mutual funds charge sales commissions, known as loads. Front-end loads are charged at the time of purchase, while back-end loads are charged when you sell your shares. These loads are typically a percentage of your investment. However, there are also no-load funds available, which do not charge any sales commissions. It's important to consider the impact of loads on your investment returns. Dollar cost averaging. This strategy involves regularly investing a fixed amount of money into a mutual fund, regardless of market conditions. By doing so, investors can potentially reduce the impact of market volatility and benefit from the principle of buying more shares when prices are lower. Dollar cost averaging takes advantage of the market's ups and downs and can be an effective long-term investment strategy. In conclusion, mutual funds are a popular investment vehicle that provide access to a diversified portfolio managed by professionals. They offer flexibility, risk diversification, and the opportunity to invest with smaller amounts. However, it's important to remember that no investment is without risks. Mutual funds are subject to market fluctuations, and past performance is not indicative of future results. Always do your research and consult with a financial advisor before making any investment decisions. That's it for today's breakdown of mutual funds. We hope you found this extended video informative and gained a clearer understanding of this essential investment option. Remember, investing in mutual funds requires careful consideration of your financial goals, risk tolerance, and investment time horizon. As always, stay informed, stay curious, and make informed investment decisions.